Jim King, investor seeking stability in what is turning out to be a fairly volatile market, can choose stable value funds. And they're not quite money market funds, they're not quite annuities, so what are they?
Stable value funds, Greg, are a conservative investment that is available in defined contribution plans and some 529 plans. They have a rate of return that's comparable to intermediate term bonds, and they outperform money markets historically by about 2 percentage points.
And why are they good when markets get a little bit choppy?
They're good because stable value have a mechanism where participants who are invested in stable value funds can always transact at book value, which is their contribution plus the crediting rate. So again, a conservative investment, not risk-free, but conservative, and helps stabilize a portfolio.
And a lot of people put them in their 401ks. Why are they good in retirement plans? What role do they play?
They can be an anchor for retirement plans. If you take a look at investors who may be skittish about savings, and this could even include our Gen Xers and our millennials who feel a little uncomfortable about saving for retirement, it's good for conservative investors, and it's also good for investors that are nearing retirement. So if you're a baby boomer and you have a significant nest egg, if you can put a portion of your investment in stable value funds, it will be protected.
Right, but money markets are also protected, and they're very liquid. Can you talk about the liquidity and transparency of stable value funds?
Sure. Stable value funds are very transparent and very liquid. You know what you're investing in. And in terms of liquidity, participants can transact at NAV, at book value, virtually at any time, in any conditions. So the underlying bonds, so a stable value fund is a bond fund and a guarantee. They're put together, and that's where they get the stability and the ability to transact at book value.
And what about fees? How much are they? Because once again, index funds, money market funds, those are cheap.
Yes, fees tend to be reasonable. If you take a look at stable value, again, it's a bond fund. So you look at your due diligence would be for a bond fund, and then a guarantee that costs somewhere around 20 or 25 basis points.
All right, and what are they yielding now as compared to the benchmark treasury?
Sure, the yield at the end of 2014 for the industry as a whole was 2.46%, which at that point in time was a little higher than the 10-year and right in line with the 10-year treasury right now.
All right, thanks a lot, Jim.
My pleasure, Greg. Thanks for having me.
And thank you for watching The Street.